Hello, everyone. I'm happy to welcome you today to AgriFin's 30th webinar on agricultural finance. My name is Valdete Berisha, and I manage the AgriFin webinar series here at the World Bank's Agriculture Global Practice in Washington, D.C. For those of you who have attended AgriFin webinars in the past, I'm glad you could join us again. And for those of you who are joining for the first time, I'm very happy to extend a special welcome. I hope you'll find the presentation useful and relevant to your work. To give you a quick background, the webinar series is one of the key ways in which AgriFin facilitates knowledge exchange among agricultural finance professionals around the world. Each month, we invite speakers to share their expertise on various topics related to financing agricultural clients. Today, we're featuring lessons from KCB Bank Rwanda on financing small-scale farmers using a value chain approach. It's my pleasure to welcome our speaker, Mr. George Odhiambo, who is the Head of Business Development and Client Services at KCB Bank Rwanda. George has a long career in the commercial banking sector, and we're very thankful for his contribution to our webinar series. During the presentation, we will hear from George about KCB's model for financing small-scale farmers in Rwanda. His presentation will walk us through the bank's motivation behind the new financing model, how the bank identifies and builds relationships with key value chain actors, as well as the innovative aspects of the model, including the inventory credit and insurance program. George will also talk about the processes for loan appraisal, approval, and monitoring. And at the end, he will also share the results to date as well as lessons learned. Before I turn it over to George, I would like to make a few remarks about the logistics. We will start with a presentation which will be about 30 minutes, and this will be followed by a Q&A session with a speaker for about 20 minutes. I also wanted to note that you don't have to wait until the end to ask questions. In fact, I encourage you to write your questions throughout the presentation, and you can do that by via the Q&A box located on the right-hand panel of the screen, which you'll be able to see. I will collect and ask all the questions at the end of the presentation, and I really hope that we will be able to answer all of your questions. But in case we run out of time, please feel free to reach out to me or George after the webinar, and we'll be happy to interact with you. We will share our contact information with you following the webinar when the emails with the recording come to you within the next 24 hours. And the webinar will end promptly at 10 a.m. Eastern Standard Time. So with that, I will turn it over to George to start his presentation, and then we'll follow that with a Q&A session. George?
Hello, everyone. Thank you, Valdette. Thank you, the World Bank team, and thank you all the participants this afternoon or this morning, wherever you are. My name is George Odhiambo, Head of Business Development and Client Services, KCB Bank Rwanda, as has been introduced. Before I move forward, let me pay tribute and appreciation to IFC team in Washington and the teams that we've worked with to make this a reality. The subject of scaling up agricultural finance to small-scale farmers to operate in a commercial basis. Without IFC support, this would not have come to this point we've reached, and we are glad that we have a partner in them and also a partner in World Bank. So, as Valdeta said, I'll take about 25 to 30 minutes to walk you through a presentation that is highly summarized, but will be good enough also to give you insight into what we are doing in Rwanda. For those who are not so much conversant with Rwanda, Rwanda is a small country in the Central Africa, population of 12 million, predominantly agricultural and very much fertile. So the smallholder farmers' attraction to us as a bank required us to think differently and to appreciate that the challenges here are uniquely Rwandan. So the model that we talk about can be replicated elsewhere with similar background. So moving straight to the presentation. Scaling up agricultural finance. The question we've had is that can small-scale farmers be financed on commercial basis? When I talk about small-scale farmers in Rwanda, what comes to mind is the land holding less than 1 hectare. And for us to be able to produce, to support big-scale commercial processing, we had to think differently. The agricultural scene for Rwanda is dominated by small-scale farmers. They are not so much experienced in accessing financial services from financial institutions, and basically farming is traditional, as has been for many years. Value chain approach is new to address the farmer issues, and we're going to also talk about some success stories. The highlights in Rwanda is that about 80% of land is classified as agricultural, and more than 80% of the population is engaged in agriculture in one way or the other. The GDP contribution for Rwanda's economy is 1/3 by agriculture, and the sector meets 90% of the national food needs, that's domestic consumption. The sector also generates more than 50% of the country's export revenues, but in a few crops around coffee and tea and horticulture to a small extent. Average land holding nationally is 3/4 of a hectare. It is expected that the growth in this area will continue until 2018 to about 8.5% per annum, and people living primarily under the agriculture sector are expected to reduce from 34% to 25% because we focus on agro-processing. Basically, the urbanization is also affecting the migration of people to urban centers, and the people directly involved may reduce, but the expectation will increase. Agricultural exports expected to increase in an average from around 20% to 28% per annum, and imports would be maintained at 17% on average. Imports here will involve things like sugar, like rice, and other food stuff that are imported from elsewhere in Asia and parts of Africa. The highlights around the government initiatives in Rwanda: we have a strategic plan for agricultural transformation under the agricultural policy in the Ministry of Agriculture covering the period of 2013 to 2017. And there are 4 main programs here. We have agriculture and animal resource intensification. We have research and technology transfer, advisory services, and professionalism of farming. That's a mouthful. The third one, we have institutional development and agricultural cross-cutting issues. Value chain development and private sector investment. The fourth arm is one where we fall in most as a bank, and this involves private sector investment, involves development of priority value chains, agriculture finance, and market-oriented infrastructure. So basically, that's where, as a bank, we find our space to play more and more in that fourth arm of the strategic plan. Some factors favoring agricultural lending in Rwanda. Government initiatives. There's policy and strategy in agricultural finance from the Ministry of Agriculture, from the state corporations and agencies. We have fund guarantees from various sector players. We have post-harvest infrastructures in silos and off-takers agreement. And we have irrigation and mechanization initiatives by the government. So these initiatives really encourage and motivate us to be part of this game-changing participation. We have new markets to explore, and large population participating in agriculture provides us with the basis to explore new markets because we can enhance our productivity. Other factors still favoring agricultural lending in Rwanda include private ownership of land. Here, land is mostly owned privately. It might be small in size, but it's private ownership. A big part of it is agricultural, and we have 2 seasons that are rain-fed, and we have a 3rd season that is irrigated. So that provides us with a space to do rapid crop planting and harvesting. Some other factors affecting us in Rwanda include smallholders, as I've said. Low-scale production, if you are to approach it as individual basis, we have some weather-related risks that is everywhere in the world. Quality constraints, having come from a background of traditional farming methods. Transaction costs still remain high because if you have small farm sizes, that means that economies of scale sometimes difficult to utilize. But you'll see as we progress how we've managed to mitigate that to make it a commercial viable practice. Collateral for smallholders is not something that they can have easily, and that's also a question that we had to address and get us a long-lasting solution. We are happy that that is no longer a hindrance in this market for us. Succession planning, just like in other business, if we have farming to be done in commercial basis, we also look forward to sustainability and also the continuity if the farmers transit and other people have to come in play. Issues of side selling sometimes do occur when farmers cite opportunities better than what they expected at the start. Storage facilities, limited silos, that also affects some farmers. But the model addresses that as we go on. Small-scale farmers will not find irrigation system as attractive, but when they come together, that works well for them. Price fluctuations in the market for agricultural produce, depending on the quantity and quality of the harvest, and record management for farmers, having to transform this from traditional way of doing things. So we basically don't have long-term records. We have records for the past 1 or 2 seasons when we deal with many farmers. So KCB comes in with a model, agricultural value chain financing in partnership with the IFC, and partnering with IFC and other stakeholders in the value chain provides a basis for us to improve efficiencies. So we have a partnership with input suppliers, that is about seeds, fertilizer, equipment for irrigation and farm preparation, agricultural insurance providers, technical support providers, some of them government agencies that we work with hand in hand, quality assessment teams, processors and buyers, among others. Beforehand, we come together and agree on what we want to achieve. This value chain financing promotes innovation in the way we do our work, in the way we engage insurance, the way we develop new products in partnership, how we manage inventory, credit facility, among other things. So most important to our farmers is the turnaround time for what we do for them. When season starts is 90 to 100 days. Every day counts. So in our assessment of risk and financing agriculture portfolio, the turnaround time is 24 hours. When we get everything asked for, in 24 hours, we must make a decision. We cannot afford to make it longer than that. We will have applied our Know Your Customer compliance requirements. We'll have reviewed credit files. We'll have checked our credit history reviews, among others. Putting in place an agribusiness unit and recruiting staff with agribusiness expertise and agronomy in KCB, that took preference about 2 years ago. So we've developed in-house capacity so that we don't deal with desktop skilled farmers, also practical knowledge staff who can assess and identify, appreciate what farmers go through. We have also trained other staff. So they're not directly involved. We train all our frontline staff in the branch network to be able to respond to basic questions or know where to refer issues of agribusiness in Asia. So in summary, the model begins by product development, and this product must respond to the need of the farmers. After that step, we need to partnership. Partnership includes everybody in the value chain, from input suppliers to the off-taker, and to other partners in quality management, to the government, and for also the media to communicate what we are doing. So we have a good engagement with the media locally as well. Risk assessment and mitigation measures are built in the value chain, and the financial assessment becomes at the tail end as we execute our mandate to support the farmers. The key is to identify the supply chains and integration with a large number of producers. Because we have small-scale farmers, land ownership is small, so you need very many farmers to be able to have sizable production that a processor will find attractive. E.g., if I want to produce 50,000 tons of maize or beans in a year, I'll be working with 30 to 40,000 farmers. And each of these farmers, their financial needs may not be more than $100 to $200 each. So you can imagine processing applications for 30,000 farmers in 1 week, requiring $100 to $200 each. It will be a nightmare. So we've eliminated that. As we move on, you'll see how that process has been simplified. So input suppliers work with us. They supply seed, fertilizers, pesticides to farmers. The loan for purchasing these inputs are paid to the suppliers. So in this model, farmers don't see the money, they don't touch the money. They get what they need. So if I'm to deal with fertilizer supplier, I pay them directly, but the farmers have the prerogative of negotiating the prices. So once they agree on the pricing, I pay directly. Because financial transactions, we are the experts. Identifying farmer cooperatives that we work with, we also rely on partners to help us identify and assess. So based on the level of management of those groups, the crops that they want to deal in, the experience they have, the seasons, timing, the infrastructures available to the point of storage, and their knowledge of what they want to do. They identify service providers, insurance companies that we work with closely. Day by day, they understand what we are up to and what we intend to achieve. We have technical support providers who will check on the diseases and other things that happen in the farm, the crop health, and what is required. These people still work with us in partnership in this chain. Buyers of this produce are specialized. They are people with experience and capacity to deliver on the forward contracts. They are people who are able to process the produce to add value into it, and there are people who are able to sustainably keep off-taking, so the farmers have incentive to continue having this engagement. On the issue of problems that affect farmers as metric information, we don't have sometimes reliable information, but using database of suppliers or buyers, government agencies, past performances, we assess cash flows and we can be able to predict what we expect in the future. The risk in both ends of the value chain, from the production to the market. The processor or the buyer acts as the off-taker, some crops, and sometimes the off-takers are layered. We have the processor as the initial off-taker, but the end buyer of the processed produce is also part of the contract. So we have layered off-taking at times. On the issue of risk of deviating financing, as I've mentioned, we don't disperse these funds in one go at the start of the season. We disperse on need and on the time of need, and directly to the supplier or input provider or farm equipment hiring, and on those stages that we require to finance. So these farmers don't have to worry about paying us monthly. They don't have to worry at who is being paid, but they just have to have an understanding on who we are getting this service or products from, at what time they will be paid. So we have, if you see abbreviations there, Clinton Health Access Initiative and Rwanda Development Organizations are some of the technical support teams that we work with. The issue of assistance on seasonal basis, post-harvest and handling support and quality assessment from service provider, this is also part of what we are involved in. So we try to learn together with the farmers, invite experts to speak to them occasionally through their cooperatives, and that makes us a strong partner to each other. The issue of collateral, future cash flows acts as collateral. If we can have citing of inventory, we have citing of your crop in a silo, that we also get assured of who is managing. Sometimes we do it jointly. We have risk-sharing facilities from different partners. And on this note, I'd like to mention IFC in particular. The risk-sharing facility goes a long way in providing comfort that we are able to deliver on this mandate of supporting farmers. Service providers also grant us credit sometimes. They don't demand that we pay them some time upfront. And the issue of assured market gives us comfort in financing and supporting this production level. Transaction costs can be high in terms of logistics, field supervision, electronic monitoring, and issue cash payments. So what we do is that we talk to groups of farmers, grouped in cooperatives, so that they can do one crop at a time so that we have economies of scale. Other risks associated with this value chain are covered by insurance, and these are weather-related risks. We have cover from insurance companies, irrigation system in place where necessary for season C, or when seasons don't seem to have enough rains at times. Delays in providing loans to farmers was a big issue initially, but having understood the model very well. So we have 24 hours to make a determination, and this is basically 2 working days for us because we don't count 9. So we talk about 24 hours here is you submit it today, morning, tomorrow afternoon, you should be having the determination of what we are supposed to offer you. In assessing our clients, we deal with legally registered, according to the legislation of the country, entities. We must have a structure of the farm management or cooperative management so that we know their governance structure very well. We also observe experience in agricultural operations, minimum 2 seasons, that is about a year for a cooperative or members. Their involvement in previous banking and lending is an added advantage, but it's not mandatory sometimes. A credit reference bureau report that also gives us clean report on their previous involvement in financing from institutions or like banks is also a good thing for us to assess, and is also prudent for us to understand. Improved and certified agricultural inputs used. We insist that only certified inputs are used. If they are seed, they must be first-class seeds. If they are fertilizer, it has to be something that is also certified to be the right quality. Market availability and price fluctuation. We have forward contracts, and this provides assurance and comfort that we will have a market. Sometimes prices may move upward, and some farmers might feel that they would have opted for the natural market cycle. That also we mitigate by not booking all the produce 100%. So we talk of 60% of your produce, we will give you market through our partners, but the 40% you can sell either back to the same off-taker or to other markets. Value chain competitiveness and other advantages are in it. So operating margins and cash flows, we consider that as a bank. We don't really have high margins in this, but we look forward to long term. So we are happy with those margins that are modest for now, so that we grow together with our farmers in this sector. Capacity management and technical teams continue to support these cooperatives. Farm productivity compared to national average within the value chain. We also try to improve that, and this is through education, through right inputs, through season timing, post-harvest handling and storage knowledge, to limit losses of post-harvest, provide dry storage and good quality maintenance of those storages. Second source of repayment is also something we consider. If farmers, cooperatives want to access finance and they opt to provide other sources of collateral in terms of other for repayment, we also agree on that. But repayment is not necessarily monthly. It's after we sell what you produce. So we structure the model in a way that we don't ask you for monthly repayment. I emphasize that because it's very important for farmers to be sure that you're not going to ask me to repay when the seeds germinate, when I'm weeding, when I'm just spraying, when I'm harvesting. You wait until I do all that process to the end, and I pay you. Loan approval and monitoring process involves not so many steps, but we collect required documents from the client. This is done at any branch. We have analysts at the center by agribusiness banker and recommendation by the branch manager. Sometimes dispersed in branches or centrally, you have those services. Assessment by credit analysts and recommendation for approval. Approval facility at different level depending on the loan limit. So we have empowerment for various officers to approve from various levels. So all this is condensed in the 24 hours so that you get your decision, and we are happy to get back to the farmers or cooperative questions. Once we approve, we have legal documentation, offer letter and loan contract drafting, security registration process, disbursement of the loan by disbursement unit. This takes another 2 days. Once we do that, we begin our monitoring process once we disburse. We monitor the loan performance, and at this point, we don't monitor the payment, we monitor utility. monthly reporting on portfolio performance. We do that to ourselves internally, to management for information and guidance, and we also do it for our partners that we work together with in financing the value chain. Post-disbursement, we have regular visits, and we also have various conversations. Once in a while, if we can manage a conducive linkage, we can do a Skype call from the farm. Portfolio performance to date, about 1.5 years ago, we began with a small portfolio of equivalent of $270,000 US, and we increased this one in 2 seasons to about $2 million. And right now we operate between $2 million to $3 million, but we have capacity to go to beyond $4 million in the next season beginning February 2016. And in this, we appreciate and recognize the support we get from our partners, IFC. The non-performing loan portfolio for agribusiness is under 2%, and our central bank regulation or guidance is 5%. So we're pretty confident that this 1.75% non-performing portfolio will even go down as we learn and we get better and better in what we do. Migration per season on non-performing loans is nearly zero. And when I talk about this 1.7% of non-performing portfolio, there are a few names, and there are reasons that were beyond their control, and we learned our lessons. It was about timing. Success stories that we operate with about 30,000 farmers at the moment every season, and the model that we are now perfecting is on maize, beans, rice, soybeans, Irish potatoes, value chains. We venturing into new ones, fish farming and mushroom farming, and considering sugar that is medium term, is not very fast. We have at least 10 partners that we work with. IFC, predominantly number 1, Access to Finance Rwanda, IFTC, RDO, which is Rwanda Development Organization, BDF is Business Development Fund, is a risk-sharing partner. We have a number of them that we work with in the value chain financing for agriculture in Rwanda. Our loan products are designed for input financing, for inventory credit facility, for contract finance, invoice discounting, and investment loan facility. So it's a wide range supporting this. You realize agriculture is not just production, but at the moment we're focusing on production to spur other sectors of agriculture, including processing, distribution, and marketing of the produce. Our success stories in inventory credit, with the first bank to introduce inventory credit financing in Rwanda market, and we're glad that people are taking notice and other banks are considering this as well. So we hope that if many of us do this for the benefit of the market, we all get better and better. So small-scale, smallholder farmers loans, as I've said, we've increased that one to high potential, and we are moving on to perfect this. Side selling has reduced. Farmers are getting more and more confident on supplying harvest to cooperatives, and we are confident that we are growing this with our partners. So a number of cooperatives, 61 cooperatives, have been linked to the formal market, and this is a case that we are proud of. They can go to the farm knowing very well that they know the end game, and the end game is return on their investment, on their time, on their skills, and their engagements that we have together with them. So some cooperatives are beginning to look for financing from us to build their own storage facilities because they were renting them before, and this will increase the margins of their profits in the future. Hopefully, they will get better and better as we continue to work them. So the model has created value to all of us. Farmers are assured of access to markets, and farmers start doing agriculture as a business on commercial basis, not as a tradition from their forefathers. They've gained knowledge from service providers. Quality of harvest is improving, and post-harvest losses are significantly reduced. Financial records are available to the users, and we are keeping more and more for future knowledge and determination of what activities we engage in. And insurance has become part of the farm, so it's no longer a hindrance to what we do. In summary, the key lessons we've learned is that developing new products and services that better farmers' needs is very important in this aspect. Also learned that banks need to have specific products targeting agricultural value chain operators, as agricultural businesses have their own specificity. They are specific to nature and they are also unique. They cannot be generic like any other product in SME or corporate. Having these services and products for agricultural clients is important. And we take it seriously that we don't have all that we should be doing at the moment, but we are open to listening to farmers so that we have to acquire sufficient skills to continue empowering them. Training of our own staff, internal capacity for sustainability is very critical for us to be able to sell the products to the agricultural clients effectively. So the issues that come up, we need to address quickly so that customer expectation is not disturbed or hindered. We deal with a seasonal business and is sensitive for timing. So in summary again, lending to smallholder farmers needs intervention and support from different stakeholders. They cannot do it themselves. We cannot be experts in it as well alone. So we need everybody. The bank does not have enough technical and financial capacity sometimes to mitigate all those involvements. That's why we work with our stakeholders. That's why we work with farmers together. And we also appreciate support that we get from other sources and from our partners as well. Bank senior level management is committed to supporting agricultural finance from production to distribution to processing, distribution, and marketing. And that commitment is important for us to move in one direction. Having agricultural lending strategy, policy, and budget allocation in our strategic plan is very key for us to be able to sustain and work for a better future in this area. Intervention from the government has been very critical and crucial for us, and commitment to support this sector of agriculture is still there, and we appreciate the government of Rwanda for working with us closely. Willingness to promote agricultural value chain finance in the government sector and the investment done in agriculture somehow reduce the risk to lend to farmers, and we look forward to do much more and more. So we could not have done this once again without IFC. So the partnership with IFC, Global Agriculture Food Security Program, and our off-takers that are layered, the next in the raw off-take and the off-taker for processed produce is very important. So we really appreciate Clinton Health Access Initiative, we appreciate World Bank, we appreciate IFC, Rwanda Development Organization, and other stakeholders in the value chain that we work with. As a time closing, the question we began with, is it possible to finance small farmers commercially? The answer is yes. Small-scale farmers can be financed on commercial basis by a financial institution, and that one we have done, experienced, and seen working. We look forward to continue doing this and this. I'd like to stop there and ask Valdette to make the final comment on the last slide that I'm displaying. So Valdette, can you hear me? Then proceed to take questions.
Yes, George, thank you. Thank you for a great presentation, and I apologize to everyone online. There were some issues with sound quality, and we have tested this a couple of times before this week, and it worked very well, but sometimes unexpected difficulties arise. So I hope you were able to hear the presentation well. And I already have collected a few questions that have come in during the presentation. And I think I will start with one, since George was just talking about the most at the end, towards the end, about the importance of partnerships in order to finance small-scale farmers. And there is a question from Victoria Rao, who would like to know a little bit more about IFC support to KCB on this initiative. So she asks, how did IFC support KCB in this initiative? What did the technical assistance include? For example, market research, product development, and so on. So if you can speak a little bit, if you can elaborate that aspect a little bit more, that'd be great.
Thank you, Valdette. Thank you, Victoria, for the question. Let me begin by IFC support. IFC is a partner in value chain financing for agriculture in KCB Bank Rwanda. To finance agriculture, it comes with various challenges, and one of the challenges is that you look for collateral in financing from a financial institution. Having said that, our farmers are small-scale holders, where you find the farm is 3/4 of an hectare, and the same farm is a home, and the same farm produces other support systems for the family. So you cannot have that as a collateral to start with. So we have a risk-sharing facility with IFC. And that risk-sharing facility, we pay a small insurance on it, and that supports us in sharing the risk. So for the start, the IFC risk-sharing facility, after we pay the insurance, takes up to 75% of the risk. So the bank and the farmers left with 25%. So this reduces with time as we learn the farmer. So we also have other local risk-sharing partners who also do similar things for us. Secondly, IFC support also comes from financing. We access funding from IFC to support agriculture, and we have a special fund from this that we have concessionary pricing that we pass over to the farmers as well. So at the moment when the base rate for financing any other commercial business in Rwanda is 16% for us, then we add a margin. To the farmer is base rate minus a significant chunk, sometimes up to -7. So this is very concessionary. To the technical support, we have a partner, Clinton Health Access Initiative, who operates in Rwanda and also operates out of Rwanda. What they do for us, they help us in identifying the right partners in terms of cooperatives we can work with. They help us create market linkages, and they also help us to monitor. So they also have got their outsourced activities to the technical support institutions that will check and walk the farmer through the season, the kind of seeds, fertilizer, and harvesting time, storages, something like that. And on the last question, if I get you, I've taken the one for IFC support, technical support. Just pardon me, the last one was Valdette?
Yes. So the last portion of the question was, what did the technical assistance include? Was it market research, product development, and related assistance?
Technical support, the technical assistance on the product development, we worked closely with one of the partners, Clinton Health Access Initiative, and we had a draft product on this. They tested it, and we agreed on a consensus on that one. On the market research is that we have got big off-takers who are not having reliable supply of farm produce, and these off-takers needed a partner that would support producers to consistently produce for them. So what this market research revolves around is to get partners who take in big scale, big quantities, so that we can initiate appetite for many producers to work together. So that market research is partly also by the government, Ministry of Agriculture, by other partners, and IFC was also involved in this market sourcing for us. So we have a contract for 5 years. So that's 10 seasons that we'll be having guaranteed offtake. Thank you.
Thank you, George. Another question has to do with insurance and forward contracts. This comes from Shannon Smith. You mentioned these earlier, and she would like to have a little bit more detail in terms of both insurance and forward contracts as tools that KCB uses to mitigate risks in ag lending. And if you can elaborate the details on how KCB is using these tools and who the partners are. You may have already touched on this a little bit, but maybe a more detailed discussion on this would be great.
Yeah, on the issue of insurance and forward contracts, let me begin with insurance. We have an insurance partner that at the beginning of season, we take a cover for weather perils and other perils associated with the farming. So this doesn't cover 100%. We have an agreed portion, significantly higher than 70% most of the time, that is covered by this insurance policy. So this is paid upfront, and cooperatives don't have to pay separately. It's inbuilt in the financial support or the loan approved. This is inbuilt. So at disbursement, the first stage, this forms first of the first transactions that we have to pay to the insurance. And they have to be helping us in doing monitoring, because they also have their independent monitors and assessors as the crop season moves on. On the forward contract, it's part of the basis of us to support this financing. All the loans that we approve for agri-business production, all of them have forward contract. And it's amazing that these forward contracts, some of them don't even get enough supply. So there's room for more and more farmers to participate in this. So one of our biggest second layer off-taker is supposed to be World Food Program, who does not off-take directly, but there's a middle off-taker who takes the raw produce to process it, then pass it over. So this value chain is linked, and we work together, and we share information from time to time. So using this model involves sharing a lot of information and open to each other and what we expect. So we also don't take everything the farmer produces. We commit to take 60% to allow them to have their own food at home and also to access other markets on the side if they wish to. Thank you.
Thank you, George. So the next question relates also to pricing of crop insurance. It says, this is from Martin, and he's asking whether, what is the pricing of crop insurance and the scope that it covers? Is it weather index insurance, or what kind of insurance is it?
Yeah, of course, weather index insurance, but this insurance cover varies from crop to crop. So we talk about beans, we talk about maize, soybeans, talk about rice and other crops. So every crop has got its own rate, and these rates normally range from between 6 to 8% of the portfolio that we are talking about, of the loan amount. So some farmers or cooperatives don't necessarily borrow 100% of their need. Their need might be half of what they're doing, and the insurance also could be different in what they're willing to cover, depending on what we need to target for the off-taker.
Another question has to do with transaction costs in terms of loan monitoring. So how do you manage transaction costs with smallholder farmers? How frequently do you visit, do field officers contact farmers in a month? Do they contact them in a group or individually? And are you facing also any competition from other financial service providers?
On the issue of monitoring for the smallholder farmers, we have a model that encourages regional participation. So you can find in one district. So when we deal with cooperatives predominantly in one area, they tend to plant one kind of crop depending on the offtake agreement. And when we have a field visit, we can have this field visit cover thousands of them in 1 or 2 days because they're in the same region and the same environment. So we have officials of these cooperatives or groups that will guide us into the visitation of these farmers. So the cover is about weather index, and it's also those perils that can come the crop cycle. And the cost of transaction, generally how we do that. As we process the loan, we just have a small fee, administration fee for charging that one. And when we talked about having partnership in this value chain financing, we are glad that we have a government and agencies that give us very subsidized way of this monitoring. So we don't pass a cost entirely to the farmer, we don't pass it entirely to the bank, and we see this as a responsibility amongst our partners. So we don't pass this cost to the farmer as such. We inbuilt this in our interest fee, which is very modest and is very low.
Great. Another question comes from Deborah Foti, and she says that the quick turnaround for loan applications is very admirable. Does KCB use an in-house developed loan management software, or do you use a commercially available package?
We use a commercially available package, and the parameters that we use for assessing this are inbuilt locally, developed locally. But this is commercially available package called Credit Quest. So it is influenced by manual intervention by inputters, analysts, and decision makers. So the main issue is not about the package. The main issue of this turnaround is involvement of the people that are charged with the responsibility of assessing the risk and determining the decision to communicate to the farmers. So it's commercially available in the market.
Okay. So the next question is about the requirement for farmers to register I think you mentioned this earlier during the presentation, and there's a question by Laura who asks about how many farmers of all farmers are registered as you require. Do you miss out on many potential customers by having this option or this requirement?
This registration we are talking about is farmers first of all registered with the cooperatives in their locality, and these cooperatives have members in hundreds or few thousands of them. So once they are registered, those cooperatives they belong to must be registered by a government agency called Rwanda Cooperative Agency. So these cooperatives are members of the umbrella organization of the cooperatives that register them. So as a bank, the transaction is between the cooperatives and the bank. So we don't have direct contracts with individual farmers. Individual farmers belong to cooperatives. Cooperatives engage with the bank. How they make a decision is that they have a general assembly or called meeting of the members. So the resolution they pass there, we have a public notary. That's a government official who will attend the meeting. Once they make their decisions and they minute them, they are read and confirmed as true. Once the government official public notary signs them, we consider those decisions as by members and submitted to us by officials of the cooperative. So in limiting market access to other farmers, that is mitigated because these farmers can join in these cooperatives in their localities. So when farmers want to access financing individually, we also have other models that allow them to individually transact with the bank out of the cooperative. We also allow that. And this will be not so small-scale farmers, medium to moderately large. They will prefer to do it individually. We also allow them, but that is in a different model. Well,
okay, yes, so there's a question about the portfolio at risk, and you mentioned that earlier that it's, I think, 1.75% for the agricultural portfolio. So it was just a reminder, I guess. There was a question, can you indicate what is the portfolio at risk for the agriculture loans? So that is 1.75, right?
Yes, as at last month.
Okay. And so there's a question that has to do with the social or environmental impact of this model. This question comes from Karina Torres, and she's asking if KCB evaluates the social or environmental impact of the model in any way, and if so, what is the main criteria? So I'm not sure if you have that in your model.
Absolutely. In our partnership with the IFC, that becomes a very critical thing. And the social environmental assessment begins on issues of labor. We will not deal with the cooperatives that hire children for that labor who should be in school. And we will also not deal with cooperatives that hinder the safety of the environment through irrigation system, polluting the environment, so doing and control clearance of land. So we do this, and we appreciate IFC support in this guideline. It's about labor, it's about issues that legislation do not allow. So the government of Rwanda in many times provide that framework so that many things that we're supposed to comply with, we find already there are regulations in the government framework. So we have that structure of environmental assessment, and we provide reports every quarter on the status of what we are doing in terms of that.
Okay, so that you have a way to monitor that, or do you rely mostly on IFC and other partners?
No, we have our field officers, our staff in the branches who do reports, and the partners that support us in the technical processes also help us to do that. So this will also, in way of disposing the refuse in those farms, water points, and issues of staff training that also go along with it. Hello? You still have some few minutes?
Oh, Sorry, I was muted. So the next question has to do with the ability of KCBs to leverage mobile technology to profile farmers. Is this something that KCB does? And then also related to that, how is credit scoring done?
On the issues of mobile technology leverage of farmers, our participation in this is an issue that we are testing. So the model operates in a way that when off-taker receives the produce, so in 3 days we pay the cooperatives. So there's another level there. The cooperatives might require to disburse these payments to several hundreds of farmers. And that becomes a logistic nightmare if they have to visit the cooperative offices for that payment. So we are testing a model that we can be transferring these payments once we receive instruction from the cooperatives on the day we pay them directly into the accounts of the farmers. We have agents working for the bank, over 300 in Rwanda, and we're using those as a basis that we form a payment channel for the farmers if they are not going to be able to access the mobile phone platform for payment. Pardon me on the last bit of the question. Hello, Valdette. The last bit of the question, you mentioned something.
Yes. So the whole question was about leveraging mobile technology to profile farmers, and then the credit scoring part that you talked about.
We are not yet at that state of profiling these farmers using mobile technology for this kind of model, but on other models that we operate in, that is something that we are considering and we've tested it. So those who want to deal with us individually, that becomes a very useful model for us. But at the moment, we are using this assessment at cooperative level, which is basically something a bit straightforward for us, and we may not need to do that detailed or micro assessment to profile them.
Great. So there's a question about related to monitoring that came in as well. And this has to do with what happens with when farmers do not comply with their contractual arrangement because they have a better spot deal. What kind of measures do you have in place for that?
First of all, to mitigate that risk, a contract covers up to 60% of the produce. And we also have got a joint assessment of the stages of the crop to harvesting to movement to the silos. So we've not had a situation in this model when farmers have not complied with the contractual obligation of the contract. Having said that, it's true that sometimes at the harvest time there are other markets that provide higher returns. And what we offer in these farmers is that predictability. And what we're also offering them is concessionary financing. So these farmers get a very concessional rate in financing so that the incentive of diverting the sales become minimal because they appreciate that we are in this for a long term and it's not a one-off. The side selling could be a one-off and they don't want to risk their long-term engagement with us for one-off sales. So we also allow, because the 40% of the produce they retail can do anything with it, wherever they want it. So the 60% estimate of the produce covers all our loans, covers all the costs, and also gives them some return in what they do. So to this extent, we think we may not say it's 100% mitigated, but we are fairly safe for that.
Great. So I think we're going to have the last question because we're approaching the end of the webinar. And I think this is requires a little bit of reflection maybe on your side. It's a question about also long-term sustainability, but also looking back. Where would you be today without the IFC support? And would there be less lending products and less value chain financing? This is a question that came from one of the attendees. And then related to that, is there a long-term plan to sustain this model without the kinds of partnerships that you have in place today and government support?
Thank you. Without IFC, to start with that, without IFC, we would not have moved at this pace. We would not have reached where we are today because IFC has supported us in very critical points in risk sharing, number one, and also in financing that is concessionary so that we are able to pass the benefits to the farmers. IFC has also supported us in trying to obtain market linkages and also have tripartite agreements with the off-taker at some stages, and sharing experiences elsewhere in the world that gives us confidence to delve into what we're doing. On the issue of sustainability, we have great hope that in the period that we are doing this, the next 5 years, we are learning these farmers. They are building relationships with us. Some of us are growing and getting out of the cooperatives and doing it individually. So we are building knowledge between each other. And this partnership is creating a relationship in the cooperative setup so that we are able to know each other well and support each other. And the risk sharing facility is graduated to decline every season. Every 2 seasons it goes down, meaning when we develop our own knowledge and understanding of the farmers, we require less and less of the risk sharing and require less and less of the partnership. So we require less and less of the concessionary pricing because some farmers who are now being able to link with the market understand how they can structure their margins and what they need and what they don't need. So we're pretty sure that sustainability is something that we are also working towards, and we are glad we are on the path to building knowledge to support farmers independently. That's the ultimate goal. On the issue that came earlier on competition, we don't consider this as real danger to us. The more the merrier. If many people support farmers, the better the world and the market for us. So the support required is too huge for one institution alone to meet. So the more the better for us. Thank you.
Thank you, George. Thank you so much. I think we will stop with the questions here. And as I said earlier, if anyone would like to get in touch with George or send a question to me or to George, we'll share the contact information later so that the conversation can continue offline as well. So I just wanted to thank you so much for taking the time to contribute this expertise and knowledge for the AgriFin webinar series with a wider AgriFin community. This is really a great opportunity for everyone to connect and listen and learn from lessons from Africa, from Asia, from all parts of the world. We will make the recording of the webinar and the PowerPoint presentation available on AgriFin's website. For those who have registered and weren't able to participate during the live session, I think they will have the opportunity to go and listen to the recording. So we also invite you to share this recording with your colleagues who may not have been able to attend the live session as well. And so before signing off, I also wanted to remind everyone about the opportunity to join AgriFin membership. And I have included here a slide at the end that just talks a little bit about AgriFin membership and the link, which unfortunately is not clickable through the WebEx slide, but it's simple to remember. It's agrifin.org/join-agrifin. And we invite everyone to become members, to become part of the AgriFin community. There's hundreds of professionals working in agriculture finance from around the world have joined and are constantly kept up to date and connected with AgriFin. There are a few benefits to join. You get priority access to our special events and as well as to various special resources that we publish regularly. Also, I would like to invite everyone to take a quick survey to tell us what you thought about this webinar today. And the survey should appear on the screen shortly. So I would like to ask everyone to take just a couple of minutes and let us know what you thought about it. This really helps us improve upon the quality and the relevance of the webinars for future. So in the meantime, if you have any remaining questions, please visit AgriFin's website at www.agrifin.org. Or, as I said earlier, you can please feel free to reach out via email that we will share when we send out the materials. So finally, on behalf of the entire AgriFin team here at the World Bank, I would like to thank George once again for contributing to this knowledge exchange through this webinar. And we also hope that the lessons shared today will help strengthen your approach to agricultural finance. So thank you, George, for taking the time from your busy schedule to speak with us today.
Thank you immensely, Valdette, also, and the World Bank team and FC in Washington, and all the participants. Thank you so much.
Thank you.